All right. Hello, everyone. This is a pretty good turnout. This was by far the most popular time zone hour for the time block for this over any of the other ones. So I'm glad that we've got so many people here for us. This is General Investment Planning. My name is Chad Lively. I'm the lead financial planner with Lively Financial. And I really made this presentation because I've had a lot of clients and I work with a lot of newer investors that are just looking to accumulate wealth. So I really wanted to make this a very down-to-earth presentation, sort of Finance 101, where we go through the fundamentals of finance. We talk about some of the more complicated things, making it a little bit more digestible. We sort of hopefully dispel some myths around investing, and I mainly just wanted you guys to sort of understand that investing is going to be a key tool for building wealth. So how do you go about the investing process? Sort of where does it begin? What are the steps along the way? What does a well-made portfolio look like at the end of the day? And I wanted to really cover fundamental principles, some terminology that you might hear on the news whenever you hear about finance, some things that you should maybe look into in terms of your own finance. I really wanted this to be accessible to everyone and a very good first start for a newer investor or someone just getting their feet wet with it. So before we get into too much finance talk, I do have to give a disclaimer for compliance. All of this is based around my financial expertise, my time with clients, my time in the industry. Ultimately, there is no one-size-fits-all financial advice. Any advice I give you or any advice anyone else gives you, take it, understand that your situation is unique to you and that you should always take into account your goals, your situation before you listen to any financial advice blindly. And ultimately, it's never bad to get a third party. If you're not sure about something, there's nothing wrong with reaching out and having an advisor help you through it. So, but keep all these things in mind as I go through it. Now we can really begin. So why invest? Well, the two biggest reasons are just to grow your wealth and to achieve your financial goals. Ultimately, you work a job, probably you're earning an income, and that's fantastic. But ultimately, if you want to have money, into retirement, whenever you may not be working a job, or during times in your life when you may not work a job, or to just grow wealth beyond what your job would allow you to have, you have to invest. Putting away some level of your current weekly income or monthly income away to have it grow into the future and ultimately benefit from compound interest. That's the goal of investing, is for someone who has possibly $50,000 per year that they make, putting away $6,500 to retire with over $1 million 30 years down the line. That's the goal of investing. And wherever you are in life, whether you're 35 now or you're just 18, investing is going to be the first step on your financial journey. And ultimately, it's how you're going to achieve your financial goals. It's going to help you fund those life's milestones. It's going to help you when it comes to emergencies in your life. And it's going to be a huge part of your financial well-being. So the first thing I'd like to talk about is that compound interest part that I spoke about. It's really what drives investing. Compound interest is why you decide, I'm going to give up some level of satisfaction today by putting away some of my paycheck for tomorrow or for a year down the line or 10 years down the line. Compound interest is what makes it worth your time to put your money away in a place where you're not going to touch it for possibly the next 3 decades. And the reason why it's so worth it is because compound interest is phenomenal, to put it shortly. This is the S&P 500. It's effectively the 500 biggest publicly traded companies in the United States. Whenever people talk about whether the market's up or down for the day, they're usually referring to the S&P 500. It was incepted in 1928, and since that time, it's averaged nearly 12% per year. And I mean, as you can see here, these are things like the dot-com bubble, the financial crisis of 2008, the Black Monday in 1987. There have been all of these financial sort of disasters that have occurred. And despite that, the S&P 500 has averaged nearly 12% per year since inception. That's pretty huge over the last 100 years. So if you'd invested your money in 1928, the amount of money you'd have now would be astronomically greater. And that's living through 3 financial disasters, which a lot of people may not end up doing. Hopefully a lot of things change, but ultimately there will be some financial disasters. The key takeaway is that the market's uncontrollable, but not random. And that if it's done well for the last 100 years, trusting in the process and assuming that the United States doesn't go bankrupt, it should do well in the next 100, hopefully. But to really tie how important compound interest is to investing and your financial goals, this is how much money you would have in your account if you put $6,500 per year away into the S&P 500 and it kept that 12-year average that it has for the last 100 years. $6,500 per year is the current amount to max out an individual retirement account. So if you maxed out your individual retirement account every year for the next 5 years, you'd have almost $45,000. If you did it for every year for the next 15 years, you'd have over $250,000. For the next 25, and you'd actually have over $1 million. If you're 35 now, looking to retire when you're 65, if you max out your retirement account every year for the next 30 years, you'll have nearly $2 million, assuming the S&P 500 maintains that average that it has, which is pretty incredible. 6,500 can seem like a lot, and there have been times in my life where $6,500 for investing seemed like a huge amount. But as you move up in your profession, or you budget better, or you start to sort of control your finances better, $6,500 is something that a lot of people can usually put away, and has some pretty life-changing consequences whenever you invest this money over the course of your lifespan. So compound interest is definitely nothing to shirk on. But the first step in investing is setting financial goals. Ultimately, you need to understand what you're investing for and how long you're going to be investing. And these are going to be what guides your risk tolerance and what helps you determine where your money should be put at, basically. So the first step is determine your financial goals. For some of my clients, that means they want to get married, so they want to plan for a wedding, or they want to buy a car, or they want to, get their first home, which means a hefty down payment, or maybe, you have children on the horizon, or, you want to pay for their education. These are all very good financial goals. And ultimately, you need to go through them. You need to determine the time horizon. How far down the line does this need to be? If you're looking to get married in the next 2 years, that saving for that wedding is going to be more of a short-term goal. Your retirement in the next 30 years, that's more of a long-term goal. And ultimately, you need to categorize this as how essential they are. Getting your third car may not be as essential as planning for your wedding or planning for an upcoming child. These are things that you need to determine with your own priority, what's important to you. And once you've decided the time horizon that these financial goals should be accomplished, as well as how essential they are, you can figure out your risk tolerance. You can ultimately determine your comfort level. You can figure out, based on your age, your financial responsibilities, and just your emotional resilience, where you can put your money at to receive the maximum amount of return for a level of risk that you're comfortable with taking. So specifically, the time horizon, short-term versus long-term goals. When it comes to long-term goals, like retiring in 30 years, you're going to focus on growth and capital appreciation. Something like the market being down for a couple of years, you can weather that when you intend on being invested for the next 30 years. A few down years is not a big deal. It's not ultimately going to impact your retirement too much. It's not something to, really lose too much sleep over. On the other hand, 2 years of a down market, whenever you have a short-term goal, getting married in 2 years, the last thing you want is to start having to pay for your wedding, and it turns out that you have less money now than whenever you first invested it. So when you have short-term goals, you're going to be looking more at preserving capital and prioritizing liquidity. Liquidity is how quickly you can convert your investment into cash money. So if you, for example, buy Amazon stock, it's pretty hotly traded. So it's very easy. You're not going to lose money for the most part converting your Amazon stock into money. This is fairly liquid. Real estate, on the other hand, is pretty illiquid. It can sometimes take weeks to months to even years to sell a piece of property. And your money is going to be tied up in that real estate investment the entire time that you're trying to do that. So with a short-term goal, you want to preserve your capital and you want to have it available when you need it. The last thing you want to do is plan on buying your first home in the next few years. And that's going to come with a hefty down payment. And whenever your dream home finally comes on the market, you can't get your down payment out of your investment because you put it into an illiquid investment. So you want to adjust your portfolio to, be based on the time horizon. And also a very important aspect that a lot of people seem to forget about is eventually every long-term goal becomes a short-term goal. You retiring 30 years down the line becomes you retiring 5 years down the line, which becomes you retiring 1 year down the line. Ultimately, your long-term goals will become short-term goals. And as that happens, you want to start converting from that growth and capital appreciation model to that capital preservation and prioritizing liquidity when you have to start living off of that. And that's usually the hardest part for a DIY investor, is sort of managing this portfolio as it slowly converts from long-term to short-term with various things in between. Now, you've determined your financial goals. The next step is opening up your investment accounts. I recommend everyone take advantage of these tax-advantaged accounts. The big ones that I'd imagine most people have heard of are your 401k and your 403bs. These are employer-sponsored retirement plans. You effectively put away money before taxes. So let's say you make $50,000 per year, and you want to put $10,000 of that away in your 401k. You would effectively only be taxed on income of that $40,000. The flip side of this is that whenever you start taking money out of your 401k in retirement, then you're going to have to start paying taxes on the money you take out. It's very similar to a traditional IRA. With a traditional IRA, you're going to put that money in, again, pre-taxes, which will decrease your tax burden. But whenever you start taking money out, that's when you're going to have to start being taxed. A Roth IRA works the opposite. A Roth IRA, you put in money after taxes. So if you make $50,000 a year, you're going to pay taxes on all $50,000 of that. And then you decide that you want to max it out with $6,500. So you put that money in, you watch it grow, and whenever you finally reach retirement and you want to start taking money out, you won't have to pay taxes on the money you take out. Whether everyone, for the most part, probably has some sort of employer-sponsored retirement account, a 401k or a 403b. I highly recommend that you at least invest enough to reach the maximum match that they offer. A lot of my clients, their company will offer, it'll match 6% of what they invest. So I recommend that you at least put in enough to achieve that maximum match that your company offers. And then you start looking at maxing out your retirement account. Some people, a traditional is better. Some people, a Roth is better. I will tell you that there are some income limitations and that you can actually make too much money to have a Roth IRA. So then you're just stuck with a traditional IRA. And for both of them, for an individual this year, $6,500 is the maximum to max them out. But when you're looking between a traditional and a Roth, what you're really taking into account is, would I rather avoid the taxes now, i.e. putting into a traditional IRA, or would I want to avoid paying taxes on it when I withdraw that money for retirement, a Roth IRA? So if you manage to, you hit that match with your 401k, you max out your individual retirement account, but you still have money left over that you want to invest, then you'd be looking at a taxable brokerage account, something like just a plain investment account. It's got no special tax advantages, but the money you put in there can then be used to buy, stocks, bonds, other investment vehicles, really the investment basics. And stocks are effectively equities. It's ownership in a company. It's got potential for capital appreciation, aka if you buy Amazon stock and it's $100 per share today, it could be $101 tomorrow or $105 in 10 years from now. That's capital appreciation. Your investment has gone up in value. Or it could also pay dividends, which is whenever the profit that Amazon makes for the year, maybe they decide that they want to distribute that out to owners. Because you own stock, you own a piece of Amazon, you would get some of that as a dividend. Another investment is fixed incomes. Typically, the people buy into bonds for that. It's where you lend money to the government or corporations, and in return, they pay you back with interest, assuming they don't default. Fixed income is usually considered less volatile and a bit safer than stocks. That's not always the case. There are risky fixed income investments out there for sure, and there are very safe stocks out there. But for the most part, across the board, fixed income is usually considered to be a little bit safer, a little bit less volatile than stocks. Then you got cash and cash equivalent investments. These are really liquid assets. They typically have very low risk and low return, but they can be converted into money very quickly. So you can put money away for, maybe a short-term goal. 1 year down the line, you're not going to get a whole lot of return on it, but you will collect some interest and you'll be able to convert it to cash very quickly whenever you need it. These are things like a savings account, a money market account, things of that nature. Real estate is a fourth big one. It's usually a lot more capital intensive to get into. There are a few ways to invest in real estate that is a little bit cheaper, but usually if you want to buy a plot of land or a house, something of that nature, it's going to take a pretty hefty down payment. And it's also something I don't recommend you get into unless you have the proper expertise and you really know what you're doing with that. Ultimately, though, for the best results, you want to diversify. There's no such thing as free money when it comes to finance, but the best you can do, and we'll harp on this a few more times throughout this presentation because diversification is vital to your investing future. You want to diversify among all of these investments to some degree. You don't want to put all of your eggs into one basket. You want to have stocks, you want to have bonds, you want to have maybe even commodities, you maybe want to have some real estate. You want to have all of these so that you aren't putting all of your eggs into one basket and risking more than you need to. You want to decrease your non-systematic volatility, your risk. Now, you've decided that you've opened up your accounts, you've decided your financial goals, you've decided what you're going to buy. Now you have to determine how you're going to buy it and over what sort of time frame. This is where investing strategies come in. The two biggest ones, and you'll probably do some combination of these, but the two biggest ones that I would recommend is a buy and hold strategy or dollar cost averaging. Buy and hold is effectively where you have a large sum of money. Like maybe you save up, all year and you're deciding on January 1st of next year, putting $6,500 that day into your investment account. That would be a buy and hold strategy. You put that full $6,500 into your retirement account and you are going to hold it there for until you achieve retirement. The benefit of that is that you are going to get compound interest on that $6,500 for the full time that it's in there, which is going to be that full next year since you put it in January 1st and every year after that up to retirement. It will also reduce transaction costs since you're only making one trade. You're only putting $6,500 into your portfolio one time, but you are at the whims of the current state of the market. Dollar cost averaging is sort of the opposite of that. It's where you invest a fixed amount at regular intervals. For example, if you want to max out your retirement account, rather than putting $6,500 in all at one time, you decide you're going to put $542 in per month. So over the course of 12 months, each month you put in $542. This is good because it's going to reduce the impact of market volatility. You are investing over a longer time horizon, 1 year. So you're not at the whims of the current state of the market, like the person who put $6,500 in on January 1st. It also does have the downside, though, of it's more transactions. So you are going to have more transactional costs. And whenever you think about how, you split your investment over 12 months, you are losing a couple of months of compound interest as you go down the calendar year. So that January 1st, $542 is going to compound more than that December 1st, $542 would, which are trade-offs. Usually you'll do a combination of these two. I recommend a lot of people, especially if they're newer, deciding that they're going to dollar cost average out $542 per month towards their retirement account to max it out. But you probably end up buying and holding if you decided you're going to sell your house and buy another house and you profited $50,000 in that purchase. That $50,000, if you move that all into the market, you're going to have a very large buy that you intend to hold for the long term. Now, you've decided your goals, you've opened the accounts, you've picked out what you're going to buy, you've moved the money in. Now is the hardest part. And that's sitting there and watching your investment do its thing for the next 30 years. Pulling your hair out, wondering why the market's up some days, why it's down others. And usually that has to do with market cycles. The bull market and bear market cycles are the two most common ones that you'll hear about on the news. Effectively, a bull market is a period of rising stock prices and positive investor sentiment. Bear market is the opposite. It's a period of falling stock prices and investor pessimism. A lot of people, and you'll hear this on the news a great deal, a lot of people fixate on that period of rising or falling stock prices. The actual more important part to what determines the market cycle is that investor sentiment. Ultimately, because the market is made up of investors just like you and me, and we're fundamentally driven by emotions, there's some inefficiencies in the market. The market goes up or down based more off of how investors feel about the future than how the economy is doing or how a certain company is doing. Just the simple thought that if every investor felt like Amazon was going to do well next quarter, Amazon would go up in value. Whether Amazon was doing well, whether it was going to do well, is completely irrelevant. And it's one of the reasons why it's so impossible to time the market. It's because you can gauge investor sentiment. There's a few ways to do it, but to accurately gauge it is very difficult. It's nearly impossible to precisely gauge investor sentiment. And that's one of the reasons why it's so difficult to time the market and why no one is able to do it ultimately. So along with market cycles, as you're moving money in and taking trades out, there will be some investment fees and expenses I want you guys to be aware of, namely expense ratios. If you put your money into a mutual fund, which is basically a pooled investment vehicle, a lot of people put their money into it, and then a portfolio manager or a team of portfolio managers then determines what to do with that money. That's a mutual fund. But that portfolio manager doesn't work for free. They receive compensation from your expense ratio. An expense ratio of maybe 1.5% of the money you put in, that 1.5%, that's going to pay off those portfolio managers that are managing everyone's money and moving investments in and out of the portfolio and things. Behind that is an exchange traded fund. It's got lower expense ratios. Typically, I err towards the side of ETFs. I find them, for most clients, a better fit than mutual funds. But beyond that, I highly recommend index funds. If you're a new investor and you're looking for an investment that will do a good job of maybe tying your returns to the S&P 500, something that doesn't have high expense ratios, I would look into index funds. They're very low-cost funds. They've got very minimal fees, and they're very beginner-friendly. So I would definitely err towards the side of looking at index funds. The other thing that you should know of is transaction costs. Commissions and fees associated with buying and selling investments used to be a lot more common. I feel like now I've seen Schwab and some other platforms start to become more commission free, but used to, it was not uncommon that if you decided you were going to buy Amazon stock, you'd have to pay $5 whenever you bought it. And whenever you chose to sell Amazon stock, you'd have to pay $5 to sell it. So transaction costs can stack up. When we're talking about buying and holding versus dollar cost averaging, putting $6,500 in on January 1st, in that example, you would pay $5 for that transaction cost. Dollar cost averaging of $542 per month over the course of a year, that $5 one time per month ends up being $60 over the course of a year. And if you're day trading or swing trading or trading really frequently, which I don't recommend, but if you are day trading, these $5 commissions on a buy and a sell, $10 basically to move in and out of a position, can really stack up over the course of a lot of trades. Now, this part goes a little bit more into how I talked about portfolio managers. So these are the ways that investments get looked at by financial professionals. The two ways are fundamental analysis. This is where you analyze a company's financial statements, its earnings, its growth prospects, its upcoming product lineups, whether or not it's had layoffs. This is where you really dig into a company's competitive position and you try to figure out what its potential for future success is. You look into whether or not you feel like, based on all of these fundamental financial knowledge that you're getting from their statements, are they priced appropriately in the market? Are they undervalued or are they overvalued? This can be very tough. It can be very tough and very time consuming for just your average investor who especially may not have a whole lot of financial background. This can take up a lot of your time, which is why it is worthwhile to offload that work to a portfolio management team. They usually have dozens of people that are each dedicated to, just following one company, Amazon, for example, as opposed to you doing it at home. You can take up a ton of time, especially when you start talking about huge companies like ones in the S&P 500, where these companies are oftentimes umbrella companies. So they have huge and successful companies underneath of them. And to try to look at the financial statements for all of those can be very taxing. But it's a big way about how, financial experts and portfolio managers look at your investments and determine whether or not they're wise investments. So it's good for you to know. Technical analysis is sort of on the other end of that. It's a little bit more pseudoscience-y in how it works. Effectively, you just look at historical price charts and try to recognize patterns to predict future movements. So you see that, for example, you see that for the last 4 Wednesdays in a row, Amazon stock has gone up $5. So you decide, on Tuesday, I'm going to buy some Amazon stock because I think it's going to go up $5 on Wednesday for the 5th time. It's obviously prior patterns do not guarantee future success, but that's sort of the goal of technical analysis, is to profit off of the market inefficiencies that I was talking about, where investor sentiment is ultimately what runs the market. The idea is that because you recognize that price pattern, other people will recognize that price pattern. And if enough people recognize that price pattern and enough people buy Amazon stock on Tuesday because they think it's going up $5 on Wednesday, that could push the price of Amazon stock up $5 on a Wednesday. And that's what you're looking for in technical analysis. It's definitely considered more speculative. There's not a lot of sort of hard science behind it. And it's usually more short-term oriented. Day traders, swing traders, they use a lot of technical analysis typically. I do recommend, for the most part, that you shy away from it. It's day traders, the vast majority of them over the long run do lose a lot of money. And technical analysis is very controversial, to say the least. But it's important that I want you guys to know about both fundamental and technical analysis. So, we've looked at a lot of the positives, how to suss out whether or not an investment is a good opportunity or not, but understanding the risk. What your risk tolerance is, how do you determine your risk tolerance, what is the risk that comes with these investments. Ultimately, a good rule of thumb is that risk and reward is very much intertwined with finance. As I said, there's no such thing as free money in finance. The greater reward you're seeking out, the more risk you're going to have to take on. And the flip side is true as well. If you find an investment that's very low risk, if it's a hotly publicly traded investment, it's also going to have very low returns for that reason. So understanding your risk tolerance is crucial for understanding how to balance your investment strategy. Most people, whenever they think about risk, they just think about volatility. They just the market fluctuations. They think about, I'm going to buy Amazon stock for $100 a share, and it's going to go up to 105, or it might go down to 95, or they might go out of business and I lose my investment. That's what people usually think of when they think of risk. But typically, risk presents itself in ways that most people don't even think about. We talked about liquidity earlier. A lot of investments, like you invest in a certificate of deposit. It's very safe. It's FDIC insured. It's offered through your bank. So it's a very low risk investment. And because of that, it also has a very low return. But the biggest risk is that it actually, it's got low liquidity. And a lot of investments like CDs is that they make you pay with the risk of opportunity cost. If your money is tied away in a certificate of deposit for a year and you have an emergency, or you want to put a down payment on a home, or just a better investment pops up, your money is now tied away behind that certificate of deposit. You've had to pay with that opportunity cost. And that's usually where a lot of risk comes in that a lot of people don't think about. So it's important to keep these things in mind and think about the fact that there is more risk than just volatility out there. There's a lot more risk than just markets moving up and down throughout the day. But it's important to stay focused on your goals, avoid reacting to short-term market movements, and Amazon stock will fluctuate, $10. It's not abnormal at all. So the easiest way to deal with risk is building a diversified portfolio. I've talked about it a lot during this, and it's one of the biggest things I want you guys to take away is how vital diversification is in your portfolio. You want to split up your investments over multiple asset classes. Like I said, a lot of my clients, they have maybe a 70-30 portfolio, which means that 70% of their investment is in stocks, 30% of their investments is in bonds. So there's some level of diversification. Beyond that, though, you don't want all 70% of your stocks to be in all technology stocks. Something like a microchip shortage will then negatively impact your whole stock portfolio. You want to be spread out among stocks. You want to be spread out among bonds. You want to insulate yourself by owning, technology stocks, finance stocks, real estate stocks, things like that. You want to spread out your money so that no one thing, hopefully, will pull down your entire stock portfolio. There are other things to keep in mind. Is stuff like geographic diversification. Things like we've had these fires in Maui. I feel like we've had a lot of fires recently, unfortunately. And if you are an investor that owns a lot of, investments in your area, you can have these sort of very localized phenomenons that will negatively impact your portfolio. I know people that live around Cincinnati. They like to invest in Cincinnati-based companies. And if there's an emergency that hits Cincinnati, these things will negatively impact their portfolio. So you want to diversify in every way that you can possibly. Some of that is geographic, for example, spreading it out amongst multiple sectors. And the big thing is you also want to rebalance periodically. I talked about having a 70-30 portfolio. If stocks are doing extremely well one year and bonds are doing fine or doing a little worse, your 70-30 portfolio can easily go from being 70-30 to being 90-10 just because the value of your stocks went up and the value of your bonds did not as much. So in that case, you've now got a 90-10 portfolio, which may not be your goal. It may not line up with your desired allocation, and it might be riskier. So you may then have to rebalance periodically. So some mistakes to avoid: chasing hot stocks. Feels like every time there's a holiday, I will have clients that will come back and they'll give me a call and they'll say, Chad, my uncle is telling me about this fantastic new up and coming tech stock. It's going to blow up the market. I want to get in on that. Or you hear some news around the water cooler about this great stock coming up, or maybe you hear people in the news talk about how like, oh gosh, this investment is going to go to the moon, something like that. And it's never wise. Avoid trying to time the market and avoid trying to predict these investments that are going to be like the next big thing. It's nearly impossible to do. It's at the very least extremely difficult to do. And more often than not, you're going to be incorrect. So the goal is to focus on long-term growth and fundamentals. If you're looking to invest for a long time horizon, just start out by making sure that your company the company you want to invest in can even exist for that time horizon. A lot of the times that I have people chasing hot stocks, they're penny stocks. They're stocks that are very new, very low value. These companies can come on the market, tomorrow and then be bankrupt in a year. These are very risky. So I hesitate everyone, don't chase hot stocks. Pick a well-diversified portfolio that lines up with your investment needs. And don't overtrade. This goes a lot back to that day trading, that swing trading. It's where you're excessively buying and selling, and it'll lead to more transaction costs if you have those. It also will lead to you missing out on compound interest for the time that your money's moving in and out of the markets. It's also, like I said earlier, I don't recommend anyone day trade or swing trade. It's very risky. The vast majority of day traders end up with a loss over the long term, and your money can be put elsewhere for better use. Even the day traders that come out with a profit, most of them, which again, 90% come out with a loss. The 10% that come out with a profit, most of them still don't make as much money as they would have if they just put their money into a well-diversified long-term portfolio. So the idea, stay disciplined, avoid making emotional decisions, don't chase hot stocks, don't overtrade. And things that really help you avoid these and things that will make investing much easier is staying educated. Like I said, there will be times that you pull your hair out because the market's down and you don't understand why. Staying educated helps with that. Staying educated helps you sleep whenever you don't understand why your investments are the way they are. But learning about investing, coming to this webinar is, I think, a great start. Learning about investing, learning about financial markets, reading books articles, having a reputable news source, and working with a professional. A big part of my job is getting to know all the investments that my clients are in, getting to know their specific financial situations and their financial goals, and making sure that they're always going down the right path to accomplish those. There are a lot of things in life that will sort of cause you to stray from the right financial path, and it can be very easy and very tempting to follow them. So a big part of my job is working with people to make sure that they, one, don't lose sleep over their investments, and two, that they do accomplish their financial goals in the long run. So in conclusion, I want you guys to understand that investing is going to be a key tool for building wealth and achieving your financial goals. It's also going to be a journey. There's going to be ups and downs. In our lifetime, there will almost certainly be some financial disasters. I mean, COVID 2020 was a huge mix-up with the markets. And while I hope nothing like that ever happens again, there will be financial disasters that happen. And ultimately, you have to understand that the S&P 500 has averaged almost 12% for the last 100 years, and that's including 3 major financial disasters. Whatever happens to us, I trust that it's going to do well for the next 100 years. So stay disciplined, always diversify, and invest according to your financial goals and your risk tolerances. All right, I know I didn't hit you guys with too much. I know that was a lot. It is now time for Q&A. You guys are able to, I think it's the bottom of your screen or the bottom right-hand corner of your screen, you're able to pop out, ask some Q&A questions, and that should, I'll get them and we'll answer them and we'll go through them together. While you guys are typing that out, I'd like to remind you that I'm Chad Lively. I'm the financial planner, the lead financial planner for Lively Financial. There's my phone numbers, my email, my website, and I know that a lot of you guys here are clients. I do see some new names. So any of you that have questions, that have concerns, I want to be a resource to help you out. I'm happy to answer anything that you have. I am happy to look at anything, and I'm always happy to help out. So please reach out if you have any questions at all. And let's get into some Q&As. So let me see. The first one that I see is, should I focus on investing or paying off debt? This is a question I get quite a lot. It's very complicated, but ultimately what it comes down to is 2 factors. 1, what is the expected return of the investments in your portfolio? And 2, how comfortable are you when it comes to living with debt and the risks associated with it? If your investment portfolio is expected to make more money than the interest rate on your debt, you would technically end up with more money down the line by putting it into your investment portfolio and slowly paying off your debt. However, that comes with the risks that are associated with living with debt and the discomfort that comes with living with debt. I have clients that they hate the idea of, even if they end up with more money down the line, they hate the idea of living with debt. And ultimately, money is just a means to an end. If your debt is causing you stress and life dissatisfaction, unhappiness, I highly recommend you pay off the debt and then go for the investments, even if it leads to you having less money down the line. Quality of life cannot be bought. So, okay. Here's another one. How do I know how much I can invest? Well, ideally you live with some sort of budget in mind, but a good general flow chart is 1, cover your necessities, food, rent, bills. 2, start focus on building an emergency fund. Then 3, you're going to want to max out that match on your 401k or 403b, like I said earlier. After that, you want to start looking at investing in your health savings account or your individual retirement account. So that's sort of a pretty good place to start on building a budget and figuring out exactly what you can afford to invest. Got what types of investments do you recommend for short-term goals, stocks, bonds, etc.? Would you still diversify for a short-term investment? Well, answer your final question first. Yes, absolutely. Whatever your investment plans are, whatever financial goals are, diversification is always wiser than not diversifying. But what types of investments do you recommend for short-term goals? Typically, like I said, you're looking at capital preservation. You want that money to be there, available whenever you need it for that short-term goal. And you asked specifically about stocks and bonds. While it's definitely not bad, I would recommend, it does depend specifically on what sort of time horizon we're talking about. Is it 1 year? Is it 6 months? Is it a couple of months? Is it 2 years? That does determine what investment I'd recommend. But if you aren't too worried about the return, I would say a high yield savings account is a great place to start. That's going to be very liquid, so you'll have the money available when you need it, and it's going to give you a pretty good return on investment relative to the risk you're taking on for that time frame. So yeah, that'd be what I'd look at. Okay. Here's another one, very similar to that one. What are some good investments in your opinion? As I sort of just mentioned, what is a good investment is very dependent on your specific situation. But I recommend any new or less experienced investor look towards those index funds I talked about. They're going to be really low expense ratio relative to some other things. They have a lot of them with high liquidity. They typically are a very cheap and easy way to buy diversification. And you can move in and out of them very easily. So I would highly recommend index funds. They're very beginner friendly. They're very easy. Warren Buffett, huge fan of index funds for a good reason. Okay. What should I consider when choosing an investment professional to help me? I like this question. So the first thing I would look into is conflicts of interest. So namely, is the advisor fee only or fee based? And what that means is your advisor, how do they get paid? For example, well, first I'll go fee based. So fee based, for example, they might collect a percentage of the money that you invest with them, the money that they manage for you, but they may also collect a commission on the investments they recommend or get paid by some other third party some other way. And what this means is that they might recommend an investment to you that's not necessarily in your best interest simply because it pays them more commission. So I would definitely recommend a fee-only advisor. For example, I am fee-only and fiduciary. So what that means is that I get paid exclusively from my clients. I only get paid the dollar amounts that you and I talk about. I only get paid the percentage that you and I talk about for managing your wealth. I don't accept any commissions or any third-party payments. It's just exclusively the agreement between you and I. That means that we always are on the same page. Your interests are in my best interests, and there's never, like I said, any sort of third party. It allows me to be 100% transparent and make sure that we're on the same page. I would say that is the number one thing to look for in a financial professional. Find someone that's a fiduciary, fee-only advisor that you can trust and wants to get to know your situation and help you out. Okay. Can I strike a balance between investing for retirement and other financial goals, such as buying a home or paying off debt? Absolutely. Yes, you can. And typically, a good financial plan will take into account multiple financial goals. A well-made financial plan should take into account all of your financial goals. Naturally, the more goals you have, the more restrictions your portfolio may also have. If you have, a lot of long-term goals and a lot of short-term goals, some amount of your money is going to be in the appropriate investments for short-term goals, and some amount of your money is going to be in the appropriate investment for long-term goals. So it can lead to a much more complicated portfolio, but you absolutely can strike a balance between investing for retirement and investing in other short-term goals. And a well thought out financial plan is a huge part to making that a very achievable process. Okay. So do we have any final questions? All right. I will, now that we're getting done a little bit early. So that's exciting. I'll give you guys a little bit more time back in your day. I'll give it till about 6:50 Eastern Standard Time and answer any questions until then, and then we will call it, you guys. So in the meantime, like I said, I've got my contact information up here. Any one of you that would like to reach out with any questions, I'm always happy to help. Happy to be a resource. You can go through our website. We've been making a lot of blog posts recently that have information about various things. Retirement accounts are a big one, sort of, how to start getting your feet wetted with investing and planning for retirement. So I actually just made a blog post about health savings accounts, which are pretty fascinating. They are, most people don't know this, but they're more tax advantaged than both a retirement account and a 401k. So health savings accounts are kind of slept on. But let me see. All right. So it doesn't look like we're getting any more questions. Thank you all for joining me. I am very glad at the turnout. This has been a very good webinar, I feel. Definitely let me know what you guys think. And I hope that you guys attend some of my future webinars. So hope you guys have a great day.